The analytical method you use and the methodology, the model, has really helped guide a lot of different people. You have a small group of readers that have been able to take action in the midst of the panic. They've actually been able to make money during this panic. So given your outlook, what do you recommend people do with their long-term portfolio? How can they protect their wealth?
Well, imagine, given the markets, my phone is kind of ringing off the hook. Obviously, we're very happy to be doing this for our readers, but I've also been getting calls from consulting clients and the media, et cetera. My wife teases me. She says, Jim, when everything's great, the phone doesn't ring, but when things fall apart, everybody wants to get you on the air or get you on the phone, or whatever, and that's fine. We do the best we can to help people in these situations. But this was one particular individual. He was a good guy, but he had lost tens of millions of dollars. A very wealthy individual who manages other family offices. And when the market first went down after February 16th, that week when it was down, about 3,000 Dow points for the week, he jumped in, got leverage, jumped in, said, listened to Larry Kudlow, which was unfortunate, and jumped in, used leverage, and bought the dips and got crushed, just got absolutely crushed. And of course, I talked him through it, and I said, I just wish you had called me 2 weeks ago, because I could have told you this was going to happen. So I'll say the same thing now. So markets are repricing. This is what markets do best. They're inefficient in some ways. They don't do it perfectly, but markets get new information, and they move to a new price level based on that new information. The problem with coronavirus and now the recession, because as I described, these things are crashing into each other, is you're trying to hit a moving target. You're trying to reprice for an outcome, but you don't know what the outcome is. My expectation is the stock market's going to go lower. They're trying to reprice for something that's a moving target. They don't know how bad it's going to get. Good reason to think it'll get worse than people expect, and that's why I've been saying that all along, but I haven't changed my view on that. So I would not rush in and buy the dips. If you're out of the stock market or largely out of the stock market, that's fine. Sit on cash. You can always buy some gold. That's not 50%, not 100% of your portfolio. I've always recommended 10% in gold. People should have had that all along, but if you don't, this is a good time to get your gold allocation. But again, not more than 10% of your investable assets. Seasoned to taste, as I say. If you like 5%, that's fine, but have some gold for sure. Beyond that, there's nothing wrong with cash. People go, I hate cash because it doesn't have a lot of yield. Well, zero yield is better than down 30%, which is what you're getting from the stock market. So people have become so conditioned to buy the dips. And by the way, from 2009 to 2020, if you bought the dips, you did okay. Every time the stock market crashed, it took a severe crash in August 2015. The stock market was down almost 20% between October 1st and December 24th, 2018. So we have seen these 10, 20, almost 20% dips before. And if you bought the dip, it came back. So people just have it in their heads, buy the dips, buy the dips. But there comes a time when it's not a dip. It's not coming back. It's a bear market, maybe a severe recession, maybe a depression. And you got to get out of the way of that. And by the way, if you've sold your stocks and you're sitting on cash and the stock market starts to rally again, I don't mean by the way, in bear markets, there are these spikes. You have these big up days in bear markets, and they're called bear traps. They sucker people in, and then bam, the market goes right back down again. We're not there. We're not at the point where you can confidently say we've hit bottom. Good time to dip a big toe in the water. Time to catch the next wave. We're not there yet. So I would be out of stocks, not 100%, but to a great extent, yes. Don't be embarrassed. Don't let people shame you about cash. Cash is good. It's always worth par. You're not going to lose money in cash, and you have optionality. You have dry powder. And if you miss the first couple percent of the next rally, who cares? I mean, you're not a day trader. Well, maybe some people are. That's fine, but good luck. But if you're in it for the long haul, if you're in it for your retirement, your health care, your parents' health care, your children's education, saving for a house, if those are your lifetime goals, you're not going to be set back by missing a couple points at the start of the next rally, but you will be set back by losing another 10, 20%, which could happen. So I'd be out of stocks, in cash, a slice for gold, not more than 10%. I'd be watching carefully and then, kind of get ready to catch the next upturn, but we're not there yet. Really the last almost 25 years at this point, going back to 1998, when the Fed bailed out the banking system at the time of the long-term capital management crisis, and then again with Greenspan's rates too low for too long after the dot-com crash of 2000, 2001, and then again in the 2008 financial crisis. Every time there was a problem, the Fed came in, cut rates to zero, printed a lot of money, and seemed to, save the day, even though things were bad for a short period of time. So the mindset set in, it's like, well, we can take lots of risk, we can use lots of leverage, we can use risk parity and passive investing and robot trading and all these things. And if we mess it up, don't worry, the Fed will ride to the rescue. Well, we may be seeing the outer limit of that. We may be seeing the point at which the Fed cannot ride to the rescue because they've used up all their ammunition. So what has the Fed done so far? Well, they cut rates to zero in 2 emergency meetings, including one last Sunday. Here's the problem. Anything has diminishing marginal returns. So what the Fed was trying to do, going all the way back to 2013 and as recently as up to the end of 2018, they were trying to get interest rates up to 4%. They were trying to get the balance sheet down to about 2.5 trillion to get ready for the next recession. And I said 3 years ago, and I've said it repeatedly, that they're not going to be able to do it. They're not going to be able to get ready for the next recession without causing a recession along the way. And that's exactly what happened. By the end of 2018, when the Fed raised rates in December, seems funny to be talking about rate increases, but December 2018, they increased rates. They pushed the U.S. economy very close to a recession. So first they went to pause, meaning no more rate increases. Then they went to rate cuts beginning in 2019. Then they got rid of quantitative tightening, which was reducing the money supply. Now they've gone all the way they've cut to zero, and they are doing quantitative easing again in an effort to stimulate the economy. But the problem is, well, now we're in a whole new world. Now the odds of a recession are at least 50%, probably higher. Well, let's just take 55 for a number. If the odds of a recession are 55%, and Trump's odds are the inverse, that means Trump's odds of winning are 45%, which means it's more likely than not that Joe Biden would win the election. Now, there's a lot of time between now and November. There are other factors in play. I don't want to put a stake in the ground, but all of a sudden we're looking at President Biden, and that has enormous. By the way, the market has not priced for that. Yes, you are showing the betting odds, and this is very up-to-date information. But the stock market's got enough on its plate with coronavirus and a recession. They haven't quite factored in the prospect of President Biden, but they're going to get to that, and that has huge, huge implications for the market.